You have a limited company. You have to do a set of company accounts. What does that involve? What do they look like? Let's have a look today. Hi, I'm Kimberly Shapcroft, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. You have a limited company. Fantastic. You've now got to do a limited set of accounts. So what are they? That's a big question I get asked on a regular basis. Let's have a look at what they look like today and what options you may have, as there are a couple of options on how you actually prepare a limited company set of accounts. Now, the financial standards that we prepare them under as accountants are all the same. However, there's different variations of what we actually prepare, depending on the size of the organisation and the want of the directors of the company of what type of accounts they wish to be prepared. Now, the differential of them is dependent on a few factors, and these we'll go into in a second. But let me just give you the headline details of what these standards are. Now, the standards that we work under today is Financial Reporting Standard 102. And this is basically the one we use in the UK under the International Accounting Standards. I am not going to bore you with those. They are not necessarily the most exciting reading, and they're definitely something that you might think of bedtime reading to help you get to sleep. However, they're quite crucial because that is how we prepare your set of accounts. Now, it goes down from FRS 102 down to something called FRS 102 Section 1A. And this is a specific section within that accounting standard which allows for small companies and basically allows you to do less disclosure and less complications in what you do in preparing it. So this might be one that we will come back to in a second, as it's one that you will regularly see. The final one that we need to mention today is FRS, or Financial Reporting Standard 105, and this is one that was set up for micro organisations. So let's start there and then we will build up again. Now, Financial Reporting Standard 105 is for entities that have turnover of less than 600,000. So that means that they are small or micro entities. Now, these micro entities won't have more than 10 employees and their balance sheet total is not more than 325,000. So let's just delve into those a little more to make sure you understand those. I'm going with you probably get that you've not got more than 10 employees is you've not got 10 actual employees on your payroll. So for a lot of property companies we see there's probably maybe no more than 1, 2 or 3 employees who are probably the directors taking some salary out of the business. So that one for a lot of companies is not a problem. Now, income over 600,000 for many a rental property, unless you've got a very sizable portfolio, you're probably going to be under the 600,000 income. And this is gross income or turnover on your profit and loss account. The final one is the 325,000, which is your net assets on your balance sheet. So this is in essence your assets, so your properties, against your liabilities and any of the money that you owe anybody, and the net total that you have on there. Now, the benefit of how the accounting standards work is it's 2 out of 3. So you've got to have 2 of them in a particular category to enable you to use them. So for most people in a small property business, you're probably going to be okay on the employees. It's going to be when your income goes over the 600,000 or your balance sheet does. So you're probably likely to fit within the micro regime if you want to be doing micro accounts. Now, micro accounts are the ones with the least disclosure. However, they are the most simplified. So today we are going to dive into a set of accounts in a moment to just talk through what they are and how they fit together. So when you come to look at your set of accounts, you actually have an idea of what you're actually looking at. Now, the next stage up comes down to the small company. Now, a small company is deemed under company law as any company with under 10.2 million turnover. 650,000 balance sheet total, and under 50 employees. So as you can see, it's gone up slightly by a step, but it's still really quite big for many property companies that are out there. Especially if you've only got a small portfolio of maybe 3, 5, 10 properties, you're probably going to fall within these two standards. Now, for a lot of property companies, I do see the small regime or the FRS 102 Section 1A accounting standards being applied, and there will be a separate video on this on the channel to discuss this small company accounts, as there is a little more to them than the FRS 105. So let's focus today on the 105, the micro company accounts, and check out the video on small company accounts if you think that that is possibly going to be the way to go for you when we've just been through the 105 ones. So let's dive into a set of accounts. So as you can see, we've now got a set of demo accounts, just to give you an idea of what a set of micro company accounts looks like. Now, there is a reason why that you may not want to do the micro company account, and one of those is that you can't revalue your property. Now, for a lot of property company businesses, this could be slightly problematic because you are looking at adding value to your properties, and you want to increase the value and make things look better and improve things. So this is why the micro account may not quite be right for you. However, the one benefit of the micro accounts is they have the most limited disclosure of them all. So you're not really telling the world an awful lot about your business, which kind of gives you a lot of protection on people not knowing more than you would like them to. So the first part is your front page. Now you'll notice on the front page that there's always the company registration number, which is a legal requirement. You've got the name of your company and it says unaudited. Now unaudited is quite an important definition. It means that they've not had a formal audit like you would see big companies where they have professional auditors come in and check all the transactions. Your accounts don't need to be audited, so therefore you don't need to have them done that way. Banks at times may ask for audited accounts, but you're not legally required to do audited accounts, so it's just very important that it's clear that they say unaudited. It will show them the period, and as you can see, these are a little old, from a few years back, but they show exactly what I need to show you today. Now, they'll normally have a contents page because that's what as accountants like to do to make them look nice and neat and tidy. And then on the next page, we will have who your advisors are, who your directors of the company are, the registered office address, and potentially the bank if you want to. So these are just the key details that they'll be able to pretty much find at probably Companies House anyhow. The next page then comes down to the director's report, which for a micro-sized company is a very simple director's report. It will tell us the period, the directors, that we've complied with the small company provisions, which again is a legal requirement that we put in there so that they are compliant for Companies House. And then they get signed off by you, the directors of the company. Now, moving on to our next page, and this is our accountant's report. So this is the accountants who prepare your accounts. They will confirm that they've compiled the information in line with financial reporting standards and put the standard that it's been reported under. And for this one, it's obviously FRS 105. And they will basically make sure that this is the relevant report that is produced. If you don't use an accountant and you do it yourself, then this page is unlikely to be in the accounts. Now, the next page then we come to is the income statement or profit and loss account, depending which terminology you use. And this is set out in a very specific format, and it basically shows your income or turnover, it shows any other income, and then it shows the expenses in specially specific defined categories that is under company law, which will then give us the profit or loss at the bottom. It will always have a comparative, so you'll always have this year's and last year's, except for your first year in business when there is obviously no comparatives. That is arguably that page. There is not much else on it. The only other thing to mention is when you actually send your accounts to Companies House for filing each year within 9 months, then you will not include this page. What is submitted to Companies House is something called filleted accounts, an interesting term I know, but these accounts are basically like the historic abbreviated accounts, and both terms generally mean that they are limited in what you send. So the income statement, when you actually send to Companies House, is removed and is not submitted. So the world cannot see what profit you are making within your business. So the next page is your statement of financial position, or also known as your balance sheet. Now, this will show all your assets and your liabilities. So assets, we're thinking fixed assets like your properties or your bank account or things like this. Your liabilities are things like your mortgages or your loan accounts to the company, anybody you owe any money to pretty much. So this is what we are seeing here, and again there is specific categorizations that we have to use under company law, and they are put into a specific order, as you can see on this page, to give you an idea of what they are. We then have our notes to the financial statements, and these are very simple for an FRS 105 company, and this is where you start to see what the difference is between a small company and a micro company set of accounts. In the micro company, we only have a few disclosures we actually have to make. One being that it's limited by shares, where it's registered and where the registered office address is. We also have to do the currency that the accounts are in, which we're in the UK, so that'll just be pound sterling. And then the other one is any guarantees or other financial commitments, and any directors' advances, credits and guarantees, which basically is, does the company owe anybody any money, and does the company have any debts with the director, and the director owes the company any money. And if this is the case, they get disclosed here. Normally under the balance sheet is how most accountants have prepared these accounts now. The final bit of the balance sheet and this section of the accounts is the sign-off. Now, the sign-off includes some specific text, some specific wording, which is basically telling them we're not doing an audit because we're exempt from having to do an audit, that you as a director have fulfilled your responsibilities, and that they've been prepared with the micro-entity provisions that are in place. And then you as the director will sign off the accounts, either one of you, two of you, and it will be dated to show when it was actually signed off. Now, a lot of this these days, especially with accountants, and I know with our practice, we do a lot of this electronically. So it all gets done more electronically than a wet signature these days. The final element of the accounts is then your detailed income statement. And this is a non-statutory page. This is basically an information sheet for you as the director, because it shows the income statement, that profit and loss, in a lot more detail. So you can actually see what's happened really. What have you spent your expenses on? And it's split out to just show what is your income turnover made up of, what is the expenses made up of, what have you spent your money on. And then that takes us all the way to the end of the accounts. And as you can see, that's it. That is your micro set of company accounts. So it's basically showing everything, but is very limited in what you actually have to share with the world. Now, the actual filleted accounts that actually get sent to Companies House are normally pretty much probably your front page, the contents page, the accountant's report, and your balance sheet and notes. And as we've said, the notes are about 2 or 3 notes that are included. So as you can see, it is quite limited in what is provided when you do a micro set of accounts. The negative side for a property company is that you cannot revalue your properties. So as you spend the money on your property and buy it, as you add some value, you wouldn't be able to then revalue the property to the new valuation, which hopefully, if you're buying and adding some value, you would probably want to. So there is a separate video on the small company accounts so that we don't get a bit too overwhelmed in today's video. So check that out on the channel, and that will explain how the small company accounts work. so you can see what additional disclosures are included. If you are very, very against disclosing or sharing anything with the will, the micro company accounts work really well. They're very limited in what they show, but they are compliant with Companies House and financial standards. If you have any questions on how the FRS 105 accounts work, then please do leave a comment in the box below, and please do add any questions you may have on anything on this area of preparing your company accounts. Hopefully today you've learned what micro company accounts are and how they look and what you can keep your eyes open for. If you have any questions on them, then please do leave a comment below and we can clear up any other questions that you may have on what a limited company set of accounts looks like. Please subscribe to the channel and do like the video and share with anyone else who might need to know what goes into preparing a set of accounts. Let's make tax less taxing.